Welcome back to the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. Now, this is another episode that I'm recording whilst on a working holiday in Ireland. So, as per the last episode, just a quick apologies if the audio quality isn't quite up to our normal standards. One of my favourite podcasts is Acquired. They do fantastic deep dives into iconic businesses such as Rolex, Ferrari, Microsoft, Costco, and many more. Recently, I listened to their episode on Vanguard, and it reminded me just how revolutionary the idea of index investing really was. Regular listeners and readers of the Gaining Choice email will know that here at Guidance we adopt an index at the core investment philosophy when looking after our clients' savings. You can therefore deduce that indexing forms a significant part of our everyday. Today, index funds are widely accepted. In fact, for many investors, they're the default option. But back in the 1970s, when Vanguard launched its first index fund, almost nobody wanted it. The challenge they faced was surprisingly simple. They were asking investors to accept average returns. At the time, the investment industry was built around a much more exciting proposition. Active fund managers promised they could beat the market. They had teams of analysts, access to company management, sophisticated research, and compelling sales presentations. Compared to that, Vanguard's pitch sounded almost absurd. It was basically, we don't think we can beat the market, we just want to own the market. Not surprisingly, many investors just weren't interested. What Vanguard understood, however, was a piece of mathematics that is difficult to argue with. The market return is the average return earned by all participants in the market. Every buyer and seller collectively create the market outcome. Therefore, before fees and costs, the average active investor must collectively earn the market return, right? They're one and the same. But of course, active fund managers don't work for free. In fact, they like to get paid quite well. They employ analysts, portfolio managers, researchers, marketers, and administration staff. Those costs are ultimately paid by investors through management fees. As a result, once fees are deducted, the average active manager must, by definition, underperform the market. That simple observation was the foundation of Vanguard's argument. If the average active manager earns the market return, less fees, and an index fund simply buys the market while charging a fraction of those fees, then over long periods, investors should be better off owning the index. And that's exactly what the evidence has shown. Historically, active fund managers commonly charged management fees of around 1% per year, and often more. Today, broad market index funds can be purchased for less than 0.1% per year, and in some cases less than 0.05%. Now, that difference might sound trivial, it's only fractions of a percent, but investing is all about compounding, and fees compound just as powerfully as returns. A seemingly small fee difference can translate into hundreds of thousands of dollars over an investing lifetime. Now, of course, active managers respond by saying, yes, but we're smarter. We can beat the market. And occasionally they do. Over a 1-year period? Yeah, quite often. Over 3 years? Possibly. Even over 5 years, some managers manage to outperform. But the problem is persistence. The evidence today is overwhelming. Consistently beating the market through stock selection is extraordinarily difficult. Now, it's not impossible, but it's incredibly rare. Markets today are populated by some of the smartest people in the world. Fund managers, hedge funds, quantitative analysts, and increasingly sophisticated computer algorithms are all competing for every small informational advantage. Whenever an obvious opportunity appears, it's usually identified and exploited almost immediately. As a result, the chance that any particular manager can consistently outperform decade after decade is remarkably low. Now, asset allocation could be a different discussion. So, decisions about how much to allocate to shares, or bonds, or property, or cash, that can potentially add value. There's some good research to substantiate that. But when it comes to selecting individual stocks, the odds are stacked heavily against active management. There's another reason indexing's been so successful, and I think this one receives far less attention than it should. Successful investing is often about doing nothing. Now, that sounds simple, but it's surprisingly difficult. Investors have a natural tendency to interfere. I often call it fiddling. We want to lock in profits. We want to avoid losses. We want to feel like we're doing something, especially if markets are going down. Unfortunately, those instincts almost always work against us. Take Nvidia as an example. Had you purchased that stock 10 years ago and still held it today, you would be up 26,000%, or roughly 74% per year. If you'd bought Nvidia 10 years ago, though, would you really have held every share all the way through to today? I don't think I would have. Most investors wouldn't. At some point, the position would have become uncomfortably large. The gains would have been enormous. The temptation to sell at least some of it would have been overwhelming. In fact, if you were my financial planning client and Nvidia had grown to represent a very large percentage of your portfolio, I would probably have recommended reducing the portfolio for diversification reasons. But an index fund faces no such emotional challenge. As companies become more successful, their weighting naturally increases within the index. The fund simply continues to hold them. It doesn't get excited, it doesn't get nervous, it doesn't try to predict the future. It simply follows the rules. That systematic approach has allowed index funds to fully participate in some of the greatest corporate success stories of our time. Then there's the tax advantage. Every time an investor sells an asset, they potentially trigger capital gains tax. That means money leaves the portfolio and can no longer be compounded. Index funds tend to be relatively low turnover vehicles. By holding investments for long periods, they defer the realisation of capital gains, allowing more capital to remain invested and compounding. The longer tax can be deferred, the greater the benefit. Now, in an environment where tax policy continues to evolve and capital gains tax becomes increasingly relevant, recent budget changes being the obvious example, this benefit that index funds have should not be overlooked. It's also worth remembering that the idea of active management, it had a stronger case decades ago than it does today. So back in the 1950s, 60s, perhaps even the 1970s, the market was dominated by individual investors, right? Mum and dads. Information travelled slowly. Research was expensive. Professional investors often did have genuine informational advantages. If a professional manager was buying shares, there was a reasonable chance the person on the other side of the trade was less informed and less sophisticated, and that creates opportunities. But markets have changed dramatically. The rise of retirement savings systems such as superannuation here in Australia and 401k plans in the United States has resulted in an enormous amount of money being professionally managed. Today, when you buy or sell shares, there's a very high probability that the party on the other side of the trade is another professional investor, supported by research teams, sophisticated technology, and vast amounts of data. Easy opportunities have largely disappeared. Markets have become far more efficient, and individual investors have gradually recognised this reality. Most people eventually discover that competing against highly informed professionals is incredibly difficult. Once index investing became available, the proposition was compelling. Instead of trying to beat the professionals, simply own the market alongside them. The research supports this approach. A famous study by Barber and Odeon, published in 2000, examined the behaviour and returns of individual investors. Their conclusions were striking. The investors who traded most frequently achieved the worst outcomes. Why? Because frequent trading created costs, generated tax liabilities, and often reflected poor timing decisions. In other words, the more investors tried to improve their returns, the worse their returns became. Which brings us back to Vanguard's original insight. Significant investing isn't necessarily about being smarter than everyone else. It isn't about predicting the next Nvidia. It isn't about finding hidden opportunities that no one else can see. More often than not, successful investing is about accepting what the market offers, keeping costs low, minimizing taxes, avoiding unnecessary trading, and allowing compounding to do its work over decades. It sounds boring, and that's why Vanguard struggled to attract investors in the beginning. But sometimes the most powerful ideas are also the simplest. All right, before we wrap up, if you found this episode interesting, share it with a friend who you think would benefit too. And make sure you subscribe to never miss an episode. We've got plenty more episodes coming to help build your financial future. If you've got a question you'd like me to answer, I respond to reader questions every Sunday in The Age, the Sydney Morning Herald, the Brisbane Times, all the Fairfax newspapers around the country. You'll find the details to send yours in the show notes. And finally, if you want to stay across the biggest finance and market headlines each week, you can subscribe to our Gaining Choice newsletter via the link in the show notes. All right, well, thanks for listening to another Financial Autonomy episode. Bye for now.